Hello and welcome to Think Ahead, our London Business School podcast that brings you sharp analysis, bold ideas, and the latest research to help business leaders navigate this rapidly changing world. I'm Sergei Guriev, Professor of Economics and Dean at London Business School. Today, I'm joined by two brilliant guests who bring both academic rigor and frontline experience to the table. Marcel Olbert, Assistant Professor of Accounting at London Business School, and Katharina Neureiter, Global Co-Head of Sustainability at Carlyle, also LBS alumna, Executive MBA 2021. In this episode, we are turning our attention to the evolving landscape of sustainability regulation and what it means for value creation in business and in private equity. From ESG reporting mandates to shifting geopolitical realities, the rules of the game are changing really fast. Marcel, Katharina, welcome to Think Ahead.
Thank you.
Thanks for inviting.
Marcel, you're doing research on transparency, disclosure in the ESG area. How does ESG disclosure regulation drives sustainable business? What is the big picture around the world? What does your research tell us?
Yeah, this is, of course, a huge area of research. So it's not only my area of research, I also look into that, but there is now a very rich body of interesting evidence produced by a host of colleagues around the world. And I would say the big picture takeaway as of today is, to keep it short, because we will dive into the details also with Katharina, is that regulation does drive change. So there is, I think, the common perception that sunlight is the best disinfectant. So in particular, transparency regulation has been shown in different settings to drive actual change. For example, reductions in environmental emissions, and also more direct regulations like taxes on carbon, which also includes emission trading systems, do have real effects on corporate behavior across the globe. That's the punchline takeaway. However, there's also rising evidence that the increasing bureaucracy is not necessarily helpful, neither for firms who bear the burden of the compliance, nor for investors who really need information that comes out of the transparency, which is informative and helpful. And more is not always better. And I think we will dive into this question quite a bit today.
Absolutely. Thank you. As a CEO, I can confirm that sustainability reporting is sometimes creating additional paperwork. And for a global firm like Carlyle, I can imagine that you have enormous experience around this. So, Katharina, as a head of global sustainability at Carlyle, what is your role? What do you actually do for a living?
It's a great question. My dad asks me that all the time. So our sustainability team is organized across three pillars. And we have quite a central team that then covers the whole firm, reporting into our COO office. Our first pillar is we call risk mitigation. This is where regulation sits. This is also where ESG data sits, and diligence and sort of risk. The second pillar we call value creation. So every single one of our asset classes, as well as underlying funds, has its own bespoke sustainability strategy. So, because obviously in credit, where it's all about risk-adjusted return and pricing, you underwrite a little bit different than in private equity, where you own the asset and can actually drive change as a sort of owner. And then the final one we call market shaping, which is, I sit on the UNPRI Private Equity Committee, which is our engagement with peers as well as our investors. And that pillar really is a horizon scanning pillar, looking ahead. What are the big topics coming up? So the last 3 to 4 years, obviously the whole industry has galvanized around what does net zero mean for private equity. Frameworks were put together. We were part of many of those. And so I think, how do you codify value creation, social issues, probably supply chain. This is sort of like on the horizon. What are the topics that are very meaningful to our investors that we need to sort of get ahead at? Physical climate risk is another one. So that's sort of how we structure our team.
For a global firm facing a fragmented disclosure regulation landscape is probably a challenge, right? Marcel knows that as well. We are in the world where new regulations are coming in. EU's corporate sustainability reporting directive took effect a few years ago. Now SEC in the US, Securities and Exchange Commission, has its own rule adopted a year ago, and disclosure is supposed to start this fiscal year. UK landscape is also evolving. How do you address those challenges of disclosure regulations?
Yeah, as an investment firm, right, we always have these two levels. One, there's disclosure on us, and then there's disclosure on our portfolio companies. And our job is basically to help to do both at the same time. One of the things, we wanted to say is our pressure, the regulatory pressure is only a part of it. A lot of the reporting we do is for our investors, for our limited partners, LPs, because they, as you say, they want transparency around how are we managing their investments and do we appropriately price and integrate the risk that our investments face, right? So like a lot of the conversations I have with our investors is around how do you integrate physical climate risk and how do you underwrite that? In the last 3 years, I think carbon emissions is probably the biggest data point that now our investors really want. And we have probably about 100 to 200 requests for all of our different funds around carbon emissions. So we started 3 years ago on the journey with new data providers to really, get them a comprehensive footprint. Because there's some of our companies which are very mature, they have their own reporting, they can report their carbon footprint to us. There's companies that are very small, for them this is very new. And then we need to estimate their carbon footprint on their behalf because our investors still want the data. They're not happy if we say, well, we couldn't get it this year, sorry. So we need to to put a lot of work into this. I think the other thing I wanted to sort of say is this is also really driving sustainability as an issue for the CFO office. Right? Because before that, I think they didn't really have to pay that much attention to it. But we've been seeing now with the ISSB and in certain jurisdictions where ESG data has to end up in financial statements, suddenly the CFOs are like, what am I actually reporting against? And that then comes into training and it comes into familiarizing people with these statements. We had a CFO that ask, okay, so if I have to publicly report my carbon emission, they are X, and my competitors Y, and my other competitors Z, what's my narrative here? What am I saying? Am I better? Are they better? What? And they never had to basically answer these questions. So there's a huge educational piece, I think, on our end that comes in with the regulations.
I also heard you're saying that there is a business case for ESG disclosure, at least in your relationships with your investors who want to understand how you're mitigating the climate risk for your companies. Marcel, what is the research saying about this trade-off between ESG disclosure and financial performance that Katharina mentioned? CFOs tracking not just profits, but also impact on people and planet.
Yeah, I think it's a very big question. I think we could run a separate postcard only on this question. I think the latter part, what do we know about, impact investing versus financial returns? I think this debate is not settled yet. So I'd like to start high level, taking a step back again. I think it's a perfect opportunity to talk about private equity firms in that specific space because you have this fragmentation that you're facing across the world, and private equity firms are often not heavily regulated because they act in the, maybe you would disagree, but act in the private markets compared to large public firms. So they don't always face, in particular their portfolio companies, not always face regulatory requirements to publish. And this gives us as a research community a chance to see what's happening in this space. Because if there's no regulation, we can observe the voluntary reporting, the business case you mentioned, and there will only be voluntary reporting if there's a business case, and what to learn from that. And that's something we set out to do with colleagues here at LBS, including Florian, to see,
That is Florian Vasvari, Professor of Accounting.
Exactly. We were interested to see, how much voluntary ESG reporting is there in the private equity industry overall globally, given that most often they don't have to publicly report. Neither the portfolio companies nor the parent firm. And we do see a huge increase in voluntary ESG reporting over the last 20 years, which already shows you there is a business case. And then we set out to explore the reasons, the determinants for that. And we found exactly what Katharina just mentioned. It's mostly driven by investor demand. So LPs, limited partners who invest in these private equity firms to then deploy capital and acquire portfolio companies. They want to know what's going on. First of all, are there ESG strategies to cater to their specific investment profiles or needs? And then second, are these strategies successful? What's going on with the emissions, for example? So we see that LPs drive this demand. For example, and I think that's almost causal evidence, we see that private equity firms provide more voluntary ESG information, for example, on their websites, that's how we measure it, if they receive more capital from investors who have signed up to the UN Principles of Responsible Investing, UNPRI. So it already shows you that that's the business case for ESG reporting information.
Maybe can I add some of that to the pressures, because I think I probably obviously largely agree with you. I think the other element that we are really seeing, where you're saying publicly listed companies have a higher degree of regulatory kind of, let's say, exposure, right? But our private equity companies are very often in the value chain of public companies. So the biggest driver we actually see is public companies pushing it down to their supply and value chain. We call it a net zero domino effect. A lot of large companies have set a net zero target. Scope 3 is their value chain. So now they're basically pushing it into the companies we be working with. And we've done an analysis across our portfolio, seeing that in Europe, Asia, and the US, for the companies that participated in our analysis, about 60 companies, about 14 billion of their revenue is tied to those type of ESG requests from their customers. That's about a third on aggregate of revenue, which ranges between 10% to over 50%. And that means that we had two small healthcare companies, they're tech companies in the US. They have AstraZeneca as a large client. AstraZeneca requires their value chain to have climate targets. So very quickly they came to us and said, how do we set our climate targets? Can you help? And so we see that sort of domino effect actually very, very prominently in the portfolio.
Maybe follow up on that. That's also what we see in the data. And I think we can learn something very important for policymakers here. So what we see in the data is that there is more ESG reporting among the private companies and ESG firms if they act in environments where there is already mandatory reporting requirements on the large public firms. So you already see these spillovers. And so there's a spillover of reporting requirements, or maybe also other ESG regulations for the big firms on the small firms and on the wider private market. And the key learning that I would take away from that is, for policymakers, maybe we don't need to overshoot with regulating the whole economy and each legal entity independently of the size, because we have maybe these positive externalities, if you want so, of maybe concise regulations that address the big fish, if you want so, and that's maybe a good middle ground, because we all know that bureaucracy and compliance costs is a burden for, in particular, many young and smaller firms.
I lived in a country where bureaucracy is actually a positively connotated word, France. And in Brussels, bureaucrats are actually very proud of what's called Brussels effect, where they introduce a regulation and make use of the fact that Europe is such a big market that big companies who want to operate in European market have to obey this regulation, and therefore you have the domino effect. In that case, it would be GDPR. The initial Brussels effect was GDPR, which was globally adopted. What Katharina is talking about, Scope 3 reporting requirement, which is part of this directive that I mentioned, Corporate Sustainability Reporting Directive in the EU. So every company which works in the EU now suddenly starts looking at its value chain, and that may actually involve companies in the US. Katharina, if we talk about this link between sustainability disclosure and value creation, would you share an example that you're proud of where a company becoming more transparent on what it's doing in the field of sustainability actually created additional value for Carlyle or other investors?
Yeah, it's a really interesting question. I think we're not looking at it sort of through the transparency and disclosure, because ultimately we are private companies. So the way we frame sort of our value creation approach, and we published that in our latest ESG report we had about 3 years ago, we talked about the EBITDA of ESG, and we took this a step forward, talking about the EBITDA of resilience, right? And I think all of us know that the world is maybe becoming a bit less predictable. As a historian, you could argue it's always been like that, but I think there's a sense right now that the velocity is increasing. So we've been thinking very closely how sustainability can help drive resilience. And the way we sort of visualized this was there's sort of a business danger zone, right? And it could be all sorts of things, a tariff regime. It could be the CSDDD regulation around your own value chain and the sort of risks associated with that. There's new chemical regulations that you have to really re-engineer your materials. And these are all business risks. So how can we use sustainability to mitigate these risks, but also like flip them into opportunity sets? So we have 3 pillars for that. One is cost savings through sustainability, right? Like rolling out LED lamps and reducing energy footprint, maybe consolidation of businesses. And I can talk through an example just in a moment. And avoided losses, which is fines, regulatory fines, and so forth. Is sort of a big bulk of sustainability. And that's sometimes the things that are not as visible. The next one we call opportunity capture, which is if you are first before your competition to reformulate some products to get ahead of the regulations, you can actually capture opportunities that are beneficial to you over your competitors. And then the last one we call adaptive capacity, which is really about innovation and, again, driving ahead, maybe launching new green pricing power, new markets that you can access where your competitors are struggling. One great example of this is a large chemicals company that we own in Spain. It's about $1 billion revenue, called Altadia. And we took them over. They had a decent ESG program. They had a decarbonization target, and we said, actually, we can do more here. And so within 3 years, we generated about 26 million of economic value for the company. We had ESG-linked financing, so better terms for meeting the decarbonization targets. The decarbonization targets led to direct energy cost saving as well as operational savings. And the third one is that through the decarbonization program, they actually reformulated some of their products a little bit and made more margin. So they improved their product margins. And all of those 3 levers basically ended up being like a few million of directly EBITDA
value
savings, value creation. Yeah, and it's and that's sort of how we really want to drive alongside our colleagues in the value creation team, sort of change in our portfolio.
Thank you, Katharina, for this example. I'm wondering, when we talk about voluntary reporting, especially voluntary reporting, to what extent investors actually trust what companies report and should have confidence in reported metrics? Do we think that there is some greenwashing somewhere out there happening as well? Marcel, what does research show about this?
Yeah, of course. That's always the big elephant in the room with voluntary disclosures. How much greenwashing is there going on? And this does not only apply to ESG reporting. This question has been out there forever. Even if there's voluntary financial reporting, there could be some massaging of the numbers going on. So there is huge evidence and research that greenwashing is happening. But then again, I think it comes down to a business case, right? And greenwashing can be like a negative NPV for the company if there is enough investor and society pressure on the company. For example, what we see, we looked at this in our research as well, because we said, okay, obviously the disclosures we see of the private equity firms, they are voluntary. So that could be greenwashing. So we did 2 things to look at that. And I think our results are broadly representative of, how to view this topic. First of all, these disclosures are seen as credible by investors, or even increase if private equity firms interact with the same investors multiple times in the same, let's say, decade. So like repeat LP investments lead to a credible disclosure. So you see, there's a business case of like not greenwashing, of course, or reputational effect. And that's maybe, the biggest takeaway from our paper, we would define greenwashing as reporting on something that you don't actually do in that way. So that's the biggest part of our research. We looked at that. Do private equity firms who voluntarily and publicly talk a lot about their ESG strategies, do they actually invest in more sustainable outcomes? And we find broad evidence that this, at least on average, for the whole global sample of our firms, is the case. So firms who talk a lot about ESG and disclose more ESG, they invest in portfolio companies who then subsequently reduce more their environmental emissions globally. Or for US sample, we looked at chemical releases. But environmental outcomes was not the only thing we saw evidence on. Also, workplace safety measures. workplace safety increased, if companies have, private equity firms have more of that ESG angle. And I think what we see makes sense. As Katharina said, there must be a business case for these sustainability strategies. And here the business case is obviously also risk mitigation. If you have a safer workplace in your manufacturing plant, in the long run, that should lead to higher cash flows. Right? And overall, we also see a kind of reputational risk mitigation when it comes to ESG issues. And that's something I think investors also care about.
So when you see voluntary reporting of good news, you are more likely to believe that good news is actually out there. So there is a positive regression coefficient in that paper. Yeah.
There is, but the key is that there is observable data on the outcome. So I would be careful with voluntary disclosures if you cannot verify actions. Right? But we could do that, and probably private equity firms know that investors look closely, and if there's evidence you can collect on the outcomes, then greenwashing would become quite costly. That's how I would view the results.
Yeah, that's a famous Russian proverb cited by Ronald Reagan, President Reagan of the United States: trust but verify.
Yeah.
And once you have verifiable or at least observable outcomes, investors can actually double check. Katharina, I would like to pick up on where you left it, talking about unprecedented speed of change and unprecedented uncertainty. I can confirm that economists use what's called economic policy uncertainty index, and it is at record high right now. We've never seen it during COVID or during global financial crisis. So we are at an unprecedented juncture. And part of that is also a debate about business and sustainability and the fragmentation of different governments' attitudes to, in particular, ESG reporting. How do you handle those issues? How do you talk to your portfolio companies and your investors about this fragmentation of the views of political class, of voters, of policymakers on sustainability and sustainability reporting?
Back to basics. That's our basic approach. I think a probably more sexy term is coined by Alex Edman, right? He talked about rational sustainability, which basically is there's social realities, people who are on 0-hour contracts. If you have a single mom on a 0-hour contract, probably not very good for her mental health and productivity. You have physical climate risk realities that are increasing. You have, and that's, you have insurance companies pressuring you to do it. So I think what we always go back to is let's leave ideology aside. We're not telling anyone in a business case to abandon a fiduciary duty on behalf of other objectives. We are talking about, what we've been saying before, risk mitigation, what do your customers want, and how do you run a better business, and basically focus on that, do that really, really well. And there's so much white space I see in my companies to still improve on the basics. We don't even need to go to sort of higher grounds. And I think that protects you in any environment, regardless of currently, is this in or is this out, or is this term good and this term bad? Go back to basics.
Yeah, I can see that in my day job as well. As a dean, I really care about international diversity of our student body. And I think there is a business case for this, because students who come to London Business School also expect to meet people from all kinds of cultures, because it's good for their future careers and lifetime income, not just well-being and excitement. And I can see how a business case for sustainability can be made to investors. And yet, if there is a regulation, that means voluntary reporting is not enough. Or, Marcel, or just policymakers just overregulate. Do you think that voluntary reporting alone will be enough? This is the question that is always arises when we have regulation on the table.
Yeah, I think that's the $1 billion question, if not more. And you as an economist know exactly the theory behind it. I think we do need regulation if we perceive that there are externalities that are not internalized by market participants, such as firms, right? And the simplest example is, of course, environmental emissions. So there is a negative externality if a company pollutes, but does not have to price this in the product. And the pollution is global. So we certainly do need regulation. I think the big question is how to strike the balance between overshooting also in terms of compliance costs and still capturing these negative externalities. If we believe in a functioning kind of market economy, then financial incentives work. And I think that's also what Katharina referred to as opportunity capture with respect to regulation. Regulation has a bite if it creates a financial incentive for firms to change behavior. And we have a lot of examples from practice and also from research that this works. A tax is one example. A tax makes a certain behavior more expensive. So you incentivize to change your behavior, and then you have a positive investment case to invest, for example, in a greener technology, or to go to a different country, or to stop a certain product. So that will work. So I would argue that we should always think about the financial incentives induced by certain regulation. And transparency regulation is not a direct, intrusive pricing mechanism. So that then it gets a bit more nuanced, and it's quite costly for companies. That's why we strike the balance, or policymakers try to strike the balance and impose size thresholds. That's like the easiest thing you can do. Only companies above a certain size should be mandated to disclose on a mandatory basis. And here we see the developments in the European Union with the CSRD and Omnibus package. So regulators have understood maybe we were overshooting a little bit by forcing 50,000 or more companies in the European market to now produce extensive sustainability reports. So this is now reduced the scope to something of, I think, 10 to 15,000 companies, because there will be a threshold of, I believe, 1,000 employees or more. So in that space, I think we really need to strike the balance. But to come to your initial question, regulation is typically needed when there are negative externalities. The question, is there a negative externality, is sometimes complicated and sometimes up to political debate, of course. And it maybe depends on the policy in a given country.
Thank you, Marcel. As an economist, and you did focus on trade-offs, and one of the trade-offs is something that Katharina's already mentioned. A private equity company usually thinks about confidentiality, competitive advantage that doesn't have to be published right away. So how do you strike a balance between what Marcel was talking about, sun as the best disinfectant on one hand, and the need for confidentiality for successful investment in private equity space? What does Carlyle do for it, and how does your practice work on it?
So in 2020, actually, we realized that the problem set that every single asset owner or asset manager asks for ESG data in a slightly different way. So basically, data was sort of collected, but our investors couldn't compare the data. And they would come to us and say, well, you collect this particular health and safety metrics in this way, and someone else collects in sort of another way. And you give us this format and someone else gives us that format. So we can't really compare, right? And so a few people got together in a small Zoom room and hashed it out and came up with this concept of the ESG data convergence initiative, which means that we converge as an industry around 10 to 12 core metrics, and all of us collect these metrics in the same way and report them in a harmonized format. So the metrics are carbon emissions, renewable energy, health and safety, employee participation, and board diversity. And these metrics go to an external body. They get verified and audited before they get sent to our investors. Or there's a portal they can actually directly get the data for the funds that are invested in. And then they get a comparable data set between all the GPs they invest in. It's been really successful. And we have from a initial group of maybe 12, now a set of 500 GPs and LPs that have committed to collecting those indicators in that way. And I think it's in a third or fourth year, a data set about 9,000 private companies that don't necessarily have public disclosures.
Marcel, before the data convergence is universal, firms probably use this regulatory and disclosure arbitrage, as well as tax competition is probably driving firms to different jurisdictions. How does that affect ESG reporting and sustainability activities of firms?
Yeah, excellent question. Of course, once you have a fragmented landscape, companies also have the incentive to avoid regulation if they do think that's financially viable. And we have early evidence on that there is regulatory arbitrage in the sense of more direct regulation, taxes, for example. I have some research also showing that companies do reallocate activities to the global south, for example, to Africa, as carbon prices increase in Europe. So we need to think about, is this something we want to stop? the EU thinks yes, that's why we will have the carbon border adjustment mechanism. But we also see evidence in the transparency regulation landscape, like where firms divest assets in jurisdictions where they would need to report on the dirty brown assets maybe. And is this something that the overall policy goal intends to achieve? Certainly not, because again, the problem of pollution is global. So yes, regulatory arbitrage exists. It's a complicated topic, and only, of course, perfect harmonization around the world can help stop that. But given the political environment we are facing, it's very unlikely to see such harmonization. And that's why we see an increasing trend in avoidance regulation that tries to stop the regulatory arbitrage, like the carbon border adjustment mechanisms, or regulation that tries to induce these automatic spillovers, if you want so. And here, one example would also be like a global minimum tax that's being discussed. If we cannot get all countries on the same page to raise corporate and other taxes to a certain level, then we try to work with a minimum tax rate such that given countries, let's say a European country, applies a top-up tax rate if your firm engages in regulatory arbitrage and moves abroad. So I think that's something we can expect in the future as the global political landscape is quite fragmented, that individual jurisdictions will think about measures to level the playing field for the businesses in their home jurisdiction.
Yes, there used to be an agreement on the need for a minimum corporate income tax rate, which now is under pressure, of course. There is now a discussion about global minimum wealth tax rate, which is unlikely to happen. The question is if we get to a global minimum carbon price, which will create market incentives for companies to adjust their activities, adjust the way they operate. Are you optimistic about this, Marcel, anytime soon?
I'm probably too unexperienced to make such a projection, but given the current political environment, you mentioned the uncertainty policy index being at a record high, probably not anytime soon, because we have very large economies like the US that or economies in other parts of the world with highly polluting sectors that employ a lot of people. So probably it's hard to get all of these economies on the same table if we cannot even agree on other globally coordinated measures. I don't know what your take is on that, but I would say it's unlikely in the near future.
I'm not sure if Katharina is supposed to provide policy advice to European or American policymakers. I would just say that I would rather agree with you, and what EU is counting on is the carbon price within EU and carbon border adjustment mechanism. But of course, as we discussed, capturing those metrics, collecting data is extremely hard. And in technical operational terms, introducing a universal carbon border adjustment mechanism will be extremely difficult. So I think we should at least hope that the companies will drive ESG agenda because there is a business case, because there is a case for value creation.
Maybe to follow up or to add one piece. And there will likely be a business case. What people don't know that even the administration in the US is considering something like a carbon border tax. They likely impound a carbon element into tariffs. And there could be a business case for even US companies to drive emissions down. But this will be packaged as a tariff regime if it will come. So things are moving quickly, but with high uncertainty, as you said.
As an economist, I confirm that U.S. government needs fiscal revenues, and the current U.S. administration likes tariffs. So I think that there is a case for this. So in the end of each podcast, we ask both guests one single question, and today the question is: thinking ahead, what are the most important sustainability regulation, sustainability disclosure trends that investors and firms should watch?
Yeah, maybe I take it a bit broader to really do a horizon scan thinking and come back with the AI point. What we're really seeing is how the future is kind of like happening now, right? So AI can really help improve the data problem that we've been having, increase data accuracy, but also really reimagine the future, both in a product sense as well as potentially from a risk perspective, right? So you have now big satellites in the sky. They can tell whether there's an adult working on a field or a child working on a field, right? And then you have probably potentially civil society that can use big data to analyze and pinpoint child labor in a supply chain. So as a responsible company, you need to be thinking about this and be one step ahead, right? Of sort of these trends to mitigate the negative risk that could come to your business. So I think for me, thinking ahead is really being innovative and thinking through the big trends that big data and AI generate from a risk management set as well as an opportunity set for your company.
Thank you. Marcel?
Yes, so we were talking about policy uncertainty. We don't know exactly where ESG regulation is going worldwide, having the US in mind. And there's also been some backlash, of course, against ESG. But what I want to do is, thinking ahead, I would like to remind our listeners, in particular students, that there's an unstoppable wave of both real-life realities and regulatory realities. We have the Conference of Party, COP, with long-standing commitments. We have things like the EU Green Deal with lots of already passed regulations that are coming. So there are lots of opportunities for students, businesses and researchers to look at these regulations and make a business case out of that, because only if we can make a business case responding to these regulations, they will actually have bite and drive sustainable change.
Thank you very much, Marcel. Thank you very much, Katharina. Thank you for joining us on this episode of Think Ahead podcast. Today's conversation highlighted how sustainability regulation and sustainability disclosure affects businesses, investors, private equity firms around the world. We'd love to hear how your organization is navigating those challenges. Are new rules reshaping your strategy, operations, investment decisions? Please share your thoughts on Spotify and YouTube using the hashtag ThinkAhead. To stay connected with the latest insights from our faculty and global leaders, please visit london.edu/think. And don't forget to follow and subscribe so you never miss an episode. Thanks again for listening, and until next time, keep thinking ahead.